Randall Kroszner is right here beside me. He is professor of economics at the University of Chicago Booth School, the #1 business school as just ranked by Bloomberg Businessweek. And he is joining me right here in the Harper Center with your outlook on many subjects. We're glad you could join us this morning. Thanks very much, Professor.
Delighted to be here and delighted to be #1.
I was just going to say, we have to talk world economy in just a minute, but do you feel like this is merited in the sense that we understand there's such a strong connection between you as professors and the student body and basically helping them get jobs after they leave here?
It's about providing people with a framework for thinking, providing them with a way of approaching the world, for understanding the tumult and changes that are out there, and also providing them the support that they need in these difficult times.
Speaking of the tumult, obviously we just wrapped up this G20, and a lot of investors, politicians, everybody wants to know what comes next. Now, before the G20, there was a lot of criticism of the U.S., of QE2, that it was essentially egocentric and foolish now that we're part of this global economy. Do you think that at this meeting, one byproduct is that the world sees the U.S. needs to be strong to have a strong global economy?
Yeah, that's really crucial. People have sort of complained about different aspects of policy, but unless the U.S. is growing, the U.S. is not going to be a real engine for other countries to grow. The U.S. is still by far the largest economy in the world, an enormous importer, and people want to export to the U.S. So if the U.S. economy is not growing, that's not going to be good for these other countries.
Now, as a result of QE2, we saw a lot of countries talking about capital controls, and I'm curious to see how many you think will actually put these in place and adhere to them.
Well, unfortunately, a lot of countries have already started down that line, putting on some tax on incoming inflows, and other restrictions. That's really problematic. I was just down in Chile, and they were doing the right thing. Rather than trying to intervene in the currency markets or put on capital controls, they're trying to boost domestic productivity to make their export sector strong. That's the only thing that is going to work in the long run, and that's what we all need to do.
If we see other countries continuing to do this, do we see, what is the risk on a scale of 1 to 10 of a global recession?
Well, I think this is not going to be the key thing that'll push us into recession, at least in the short run. If it gets out of control, then it certainly moves things up on that scale. In the short run, we've got to be able to keep free and open markets for capital and for trade, and that's going to be crucial for revival.
And how hopeful are you that that's the scenario that will play out?
Well, I think we've gotten so far good discussions on trade, that we haven't put up a lot of trade barriers. A lot of questions now on capital controls, some coming in. But so far, a number of major countries have stayed away from that, and that's going to be crucial.
We spoke a lot about what comes next post G20. What comes next domestically post QE2?
Well, I think we have to see how that plays out. We have to see whether we start to revive job growth. We got some better numbers coming in this last month, but one new number does not a new forecast make. We've still got the unemployment rate at a persistently high level. We've got the inflation rate at an uncomfortably low level starting, and it's been moving down. That's a very challenging position to be in.
I've heard Ben Bernanke make reference to QE2 as sort of a golfer using a new putter. Tap a little bit, see what happens until he can sort of figure out just how strong the putter is. How intense are the discussions right now inside the Fed? There seems to be a lot of dissension.
Well, I'm sure the discussions are quite intense, but they're always very robust. People have different points of view. That's one of the excellent things about the unusual structure of the Fed system, that we have a number of people who are appointed by the president and confirmed by the Senate in Washington, and others from around the country to give different perspectives. And so the way to make the best argument...
But you don't see it as bitter?
Oh,
even when it goes public?
No, there's always a difference of opinions. And I guess sometimes it's very simple for everyone to agree. In tumultuous times, you're going to have different points of view, and that's what makes a better decision, to have different people with different points of view.
So, Professor, I have to put you on the spot because you're a former Fed governor. Do you agree with the policy right now?
I think it's important that the Fed has taken out some insurance against the potential downside risk of deflation and deflation expectations. What happened in Japan is they didn't act. Inflation was starting to come down and started to get into the deflation area. The the Central Bank of Japan was very slow to respond. They got into this deflationary situation and haven't been able to get out for 15 years.
So you think had the Fed not acted, we would have been at risk to be the next Japan?
Well, I think at some risk. I don't think it was a high risk, but it was a small risk of a very bad outcome. And right now, the cost of buying that insurance is in terms of the potential for inflation. Right now, inflation is very low, and given the persistently high unemployment rate, it's very hard to see a lot of inflation pressure over the next year.
Professor, let me ask you about the way that the markets have reacted, because the yield curve has steepened since QE2. The dollar has actually strengthened. So does this imply that the U.S. economy is actually recovering on its own, dare I say it, or is it just that the Fed was really late in making its decision?
No, the Fed was early in making the decision, because you really have to look at what happened in the markets from when the chairman started talking about this in August until now. And so the dollar weakened a bit, but not dramatically, and you can see it's now strengthened since the policy has been announced. The interest rates, the 10-year rate is down below where it was, and the inflation expectations have ticked up a little bit, but not too much. And so that helps to reduce the real rate, the real borrowing cost, and so that provides the foundation for recovery. It's not going to do it on its own. These are the necessary conditions. There's a lot of other stuff going on in Washington on the fiscal side, on the regulatory side, that has to be worked out before firms can feel comfortable in hiring workers on a permanent basis.
Is the Fed the only game in town? I mean, you alluded to Washington. There's a split Congress. I mean, can we hope for any kind of fiscal stimulus?
Well, I'm not sure that I think what we need to do is avoid fiscal mistakes. And so I think a dramatic tax increase at this point would not be helpful. But we also have to deal with the long-run fiscal issues. And I think the bipartisan commission has come up with a number of ideas, a number of very controversial ideas. But I think the only way that we can really move ahead and have the true foundation for growth is to make sure to avoid a sharp fiscal contraction in the short run, but have a clear path for dealing with the fiscal problems that lie ahead of us.
Professor Kroszner, thanks so much for the time. Congratulations again on the #1 ranking by Bloomberg Businessweek. That is Randall Kroszner, former Fed governor, professor right here at the University of Chicago Booth School.